All right. Hello, everyone. We are live. Welcome to the latest episode of the ASX Small Cap Wrap, your favorite podcast for the niche subject matter of ASX small cap stocks. I'm here with Patrick Pope. G'day, mate. How are you?
I'm good. Thanks, Claude. How are you?
Yeah, very well. I'm actually very tired. It's the end of earnings season. And what's more, actually, this day that we're recording it, Thursday, the 28th, it's now getting to the point where the companies that aren't so good are putting out their results. So whereas I've had some nice wins earlier in the earnings season, I haven't not had some nice wins today. So that's a pity. Never mind. You have some good days in earnings season and some bad days. So that's just par for the course, really.
Indeed.
Yeah. The only way that I could think of to have just good results during an earnings season would be if you owned, like, say, 3 stocks or something like that.
Only problem is if you own 3 stocks and one of them's bad, it's going to really hurt.
yeah, exactly. Once you get like 12 or something, even it's, you can't get 12 right every earnings season. Even a great company, it goes down on earnings sometimes. Anyway, speaking of that, before we get into the first company we'll discuss today, which did go down on earnings, at least initially, I want to do the usual traditional ritual disclaimer. So we haven't considered your investment objectives. This is not intended as advice. We're just going through basically sharing some information about the recent earnings results of 4 different small cap stocks. And you definitely shouldn't be basing an investment decision on these comments. It's just necessarily incomplete. And in any event, should any opinions be considered advice under the law, then that advice is authorized under by me, which is AR 1297632. You can also just check the full AFSL number and my AR number and everything in the description of the video or the podcast. And with that out of the way, I'm going to talk about 2 stocks today, which is first of all, XRF Scientific. And then second, what was my second one again, Patrick? I've forgotten now.
Cuscal,
right. That's right. So I own both of these shares. I'll probably mention that again, but just get that right off the bat. Both stocks that I own shares in, and I own shares prior to these results. And Patrick, what will you be talking about today?
I will be discussing PWR Holdings, that's PWH, and I'll be discussing Monash IVF, MVF. I do hold PWR Holdings, and I do not hold Monash IVF.
Great. All right, cool. Well, I look forward to hearing about your experience with MVF, especially because that was a small cap mailbag suggestion from one of our recent supporters. So, essentially part of what we do is we just choose companies that we like to write about. And then also part of what we do is we listen to what companies our readers or our supporters, which is our subscribers, what they like as well. So if you become a subscriber, you can just email us with, a small cap mailbag request. And if we have someone, on the team who does know about that stock, then we can cover it. And Patrick, you've got an article on Monash IVF on the website. But look, straight into it. XRF Scientific. Now, this is one of my favorite stocks, actually, a small cap stock. It is one that I own in my portfolio and have done for some time. I've followed it for many years. And it's just one of those classic areas where, it has this non-descriptive name, XRF Scientific. You've never heard about it. Like, no one's at the pub being like, oh, have you heard about XRF Scientific? It's just never happened, right? So at least it was like for a long time really under the radar. Now, what they actually do is they sell equipment and consumable products that are required for the testing of geological samples. So that could be a crusher that crushes rock from a mining company. Then you get a little bit of a sample of that. And then you might use platinum labware to move that sample around and then use that platinum labware to heat it up or melt it, or use their XRF flux machines to do like this X-ray analysis to know exactly what minerals are in the sample. And believe it or not, one of the main products they sell is this flux, this X-ray flux. Look, I'm not going to pretend I'm obviously not like a scientist that understands all these chemicals, but what I do understand is that first they sell the machine that does the analysis, and then on an ongoing basis they sell this like liquid pellets, I think it is, but they sell this flux product to that is necessary for every time the machine is used for analysis. Et voila. On top of that, they sell and recycle the platinum labware that scientists also use for all of the heating up and the handling of these rock samples that they're trying to get the very precise, constituents in these samples. So they also sell this labware that's used for that, and then I think there's some recycling program as well.
So the old razor and blades model.
Yeah, exactly. That was what originally caught my attention a while ago. Share price has moved up a fair bit since I bought shares. And look, I want to go into the highlights for the results now. So essentially, for the full year, there was a profit after tax of 10.4 million, which was up 17%. Remember that, because that's obviously that's their profit growth rate in the year. But revenue was down 1% to 59.5 million. Now, in most companies, if you saw profit up and revenue down, if you're a, share stock market sleuth or whatever, obviously the experienced hands know this, but that is generally not a good sign, because in most scenarios, what that actually means is that they're kind of cutting costs or something. And that is usually a less sustainable form of growth. Ergo, you can't extrapolate the growth rate out if that's what's happening. However, XRF Scientific is an exception to that general rule, because very much part of its revenue, the price of its consumable products depends in part on the price of lithium. And a couple of years ago, we had this huge price spike in lithium, which meant that they put up the price, they basically passed that on to their customers. However, as lithium's come down, they've been also passing that reduction down onto their customers. So even though the revenue is down, it doesn't mean that the volume or the demand was down. It just means one of their input prices that was previously being passed on has come down. So that's it. It's not a problem. The other really good thing that came out of this result was that the fourth quarter was a record net profit before tax of 4.3 million. So now you cannot just annualize that fourth quarter, because often the fourth quarter is, it can go up and down. You can't be guaranteed the next quarter will be as good, but still that does happen to be a record quarter, which has set a new high watermark for profitability of the company. And of course, there's going to be a down quarter sooner or later. If you look at the chart of the quarterly profit before tax, it sort of goes up, down, that kind of thing. It's very uneven. And that's because a lot of XRF Scientific's revenue comes from sort of sales of capital equipment or crushers or whatever it may be. And that's kind of like a one-off sale, and they don't always, since they're big buys, they don't always come evenly throughout the year or anything like that. So very volatile in that part of the business. And really the consumables bit has been the hero. So for example, if you look at the segment profit before tax by half year, I think since 2021, they've owned that consumables business has only had one very mild down half that was kind of a bit flat. And then this latest half actually was pretty flat for that consumables segment net profit before tax as well. So hoping to see an improvement on that in the next half year. This most recent report, the capital equipment segment net profit before tax was the hero. And as I said, that is a bit of a lumpier side of the business. So again, there's a lot of reasons why you wouldn't get too euphoric about this record profit before tax that they made in Q4. Nonetheless, it's still a positive, even if you take it down. So overall, I thought that these results were good. I continued to find the stock attractive after the results. But this was one of those funny situations where even though the results seemingly were good, the share price actually went down. And initially, when the results came out, let me just check what it was, but it was like, the results came out. It had been like 216 or something like that. And then it dropped down to like 207. And then it's just bounced back up to 227. But even the initial response from the market was down. When I wrote my article about these results, I was looking at, $2.07, and then it's gone back up. So it just shows you don't always take your lead when the results are good or bad. It's not a good plan to just look at, is the stock up or down? If it's up, good results. If it's down, bad results. In small caps, this is why I love small caps. In small caps, don't do that. Yeah, that's probably always true in large cap, or mostly true in large caps. But in small caps, a few people's opinion can change something to good or bad. So yeah, ultimately, there's a few things to take away with that little lesson. But I thought I'd lead with that because that was one of the results that I felt was pretty positive in small cap land. And yeah, as I say, a stock that I still own shares in myself. So full disclosure there. No plans to sell anytime soon, but things could change in the future. You never know. And I've got no way of telling people who are watching this now, hey, I've changed my mind. So I guess, yeah, always you'd have to subscribe to the website to know when I change my mind about something.
I'm curious. I couldn't actually see in the presentation if there's specific commodities that they're exposed to. I guess kind of indirectly through that consumables business, they've almost got they're negatively correlated with lithium prices. But are there specific commodities that they've got more exposure to in terms of who they actually sell to?
I imagine that there would be, to some degree, there would be some commodities that they have more exposure to or less exposure to. But I don't think that's the main thing. I think that the main thing is that they have a lot of exposure to the overall mining industry. So because of their exposure to that overall mining industry, if generally miners are doing well and commodities on their up and they're drilling more holes and exploring more, et cetera, that's a good thing for them. Alternatively, if there's a big recession and a slump and, people started mothballing mines in general, that would be bad for them. But I don't know the exact exposure to each commodities. It's also geographies, like Australia and Canada would be big ones for them. So they're just those sort of mining kind of places. So overall, I don't know which commodities they're most exposed to, but they're definitely overall exposed to the mining industry. Anything else that you had any commentary after I told you that little spiel on the results?
No, I think that was the main question that kind of came up for me as I was looking through the results. It would be interesting to see what things look like if you kind of smoothed out that capital equipment result, just to get a bit of an idea of the underlying trajectory.
One observation I wanted to make is I think actually the time to kind of buy this stock is when the capital equipment segment has had a bad quarter, because generally speaking, that can mean the share price goes down a bit on that sort of disappointment or even a bad half. But then experience has shown that over the course of time, that has trended up, in large part because they have been making small bolt-on acquisitions to add to their product range, etc. So actually that's probably to keep an eye out for if you want to start learning about the company. Perhaps the time, I have no idea if the price will be up or down, but generally speaking, as a rule of thumb, over the years that I've followed the stock, I would say the better time to buy is after a week performance from the capital equipment division. Anyway, moving on. Let's go to you now, and you were going to tell us about Monash IVF.
Yeah, this is a pretty interesting story. So I actually used to own the stock a while back, but I sold it well before these results came out, but unfortunately not soon enough. Monash IVF, I mean, the underlying industry economics in what they're doing are actually quite good. People generally having kids later on in life, which means that that fertility can be more difficult, which drives more people towards using IVF services. There's also more same-sex couples having kids. and generally just falls in fertility across the world, which is an interesting subject on its own. But unfortunately, the company's been involved in a string of incidents over the last few years that I think has really left a pretty poor taste in many investors' mouths. Certainly myself, that's true. And I think also looking at where they're at now, it may have actually affected the views of potential patients as well, which I think is at least implicitly reflected in the results. But in terms of what actually happened there, I'll just try and give a brief overview because it is a very long story. But about 5 years ago...
I'll jump in there first. I'll just say that for somebody who wants to actually get the order of events here, I recommend you just Google Monash IVF and Patrick or Patrick Poke or Monash IVF A Rich Life and just find his article because he's got the whole list of all of the weird legal troubles and mistakes that they've had there. So we won't just go through it all. But essentially, can you just give us what's the one that is the thing that you think's the worst one?
Yeah, look, I think the worst of the incidents, in my view, is what was called the NIPGT. I won't go into detail about what that means, but effectively, Monash IVF settled without admitting fault in this lawsuit. It started in 2020. The costs were booked mostly in FY24, though the actual settlement happened in FY25. Essentially, there were some tests that they were selling, genetic tests selling to patients, and the tests were found to not be accurate, which resulted in the patients believing that the embryos, which may have actually been viable, were actually not. Adding to that, there were allegations that some of the embryos which patients were told were destroyed were actually not destroyed. And there were further allegations along the lines of forged consent forms, doctored clinical trial results, and the burning of documents to cover up.
And that's in an ABC article.
If you have a look at my article, everything here is thoroughly sourced if you'd like to check the background.
The ABC article that he's referring to then is called Monash IVF Mix-Up that saw woman give birth to another person's baby may set legal precedent, I think. That's it.
That's actually relating to one of the other incidents. So there's actually three separate incidents. I won't go into all of them, but...
the discarded one. Yeah, anyway, you have to go and check our website and you got all the links there to that. So, we don't have the proof of this. This is just what's been reported. So I think that does... Look, I think that really covers off on what really matters about Monash IVF. At this point, all the details of the recent results, et cetera, all the numbers, the charts, et cetera, that's on the website in Patrick's article if you want to deep dive into it. The reason that someone might be interested in this stock is, as you can imagine, the share price has dropped precipitously. This puts it on a low PE ratio of whatever, assuming there's no surprise costs from some terrible thing that's happened. Of the normalized earnings that it's kind of earned in the past, it's on a low PE ratio. Obviously.
Yeah, that's right. Though, if you have a look at the guidance that they provided, suggested that their normalized earnings would be in the range of... I think it was 20 to $23 million for FY26, but they also flagged about $5 million in one-off costs. Now, assuming they're all expensed and not capitalized and using the midpoint of their guidance, you end up with around $16.5 million of NPAT based on those projections. Which is NPAT.
Yeah, but even if we just use their numbers of underlying NPAT, in that case, it's $20 million. Well, the market cap at the current price, the share price is about 70 cents. The market capitalization, according to CommSec, is 265 million. So it's between 10 and 11 times that number, that earnings number, right?
So based on what I've got here, if we use the midpoint of that guidance, so 21.5 million, not adjusting for the 5 million
I'm just taking
in one-offs, that's 12.3 times earnings and implies a 16% fall from this year. So yes, it is cheap. but if you look at it on a trailing basis, but it looks like earnings are declining, not improving. And when you actually break it down into their half by half, there is some seasonality to their results, but the second half result did look significantly worse than the first half result. And so if that's a trend, then while it looks relatively cheap now on rearward looking earnings, on forward earnings, it maybe doesn't look as cheap.
Yeah, I look, even based on their guess at forwards earnings, I don't think it's that obviously cheap. But I think that the thesis, I guess, also the other thesis would be, but this company has heaps of earnings potential, and what can happen is somebody else can come and look at it and be like, oh, well, if I just took this over and changed the management and put in like my guy who I know is a great CEO or whatever it is, I can come and make this thing way more profitable than it is at the moment. And I think that's actually the most viable thesis, essentially. Like, I don't think that's going to happen. I'm not saying that's going to happen, but I'd say that's the best chance of making money in the medium term from here.
I would agree. It's not the way I like to invest. I'm happy to invest in something that looks like it could be a takeover target, but it needs to be able to be a good investment even if it doesn't get taken over. And for me right now, at the current prices, I wouldn't really be interested. I'd actually want to see a turnaround in the business itself. It's not so much about the price. For me, it's can the new CEO who's taken over after the long-serving CEO left in June, can the new CEO actually turn the business around? We need, and even if they can turn the business around, how long is it going to take for investors to get comfortable with owning it again after a string of events like we've seen? So for me at the moment, I'm not looking to become a shareholder again.
Yeah, cool. All right, moving on now. The next stock that I wanted to talk about is a company called Cuscal. Now, Cuscal is a business that does sort of the back-end tech infrastructure of financial institutions that are not the big four banks, because they have their own back-end tech infrastructure. I actually wrote about this company back in April 2025 on an article that anybody can read, but you just have to Google like Cuscal, Claude Walker, or the name of the article is The Potential Hidden Small Cap Gem Still Flying Under the Radar. And that's a bit old now because it's obviously like not as under the radar as it was before. But essentially, this thing is a bit of a weird little beastie, as I cover in that article, in that it's like this really old company that sort of started as a cooperative for credit unions, et cetera, et cetera. And it was just floated at what appeared to be a reasonable price. And it basically the shares, 30% of the shares were escrowed until the day after the release of the FY 2025 results, which we've just had. Now, essentially, my argument in that article, which I won't rehash now, is that it's like cheap based on its growth potential. Like, it was a P under 20 from what I thought for FY 2025. And on top of that, it'd keep growing because it has this sort of clip the ticket style company. Now, by that, I mean, it basically takes a small amount of every transaction or charges by the amount of money going through its system. And so I kind of like these companies because they have kind of inbuilt growth with the economy as the economy grows. So I kind of like that side of it. Just I feel like there's a bit of structural automatic style growth in those businesses. And then what happened was with these FY 2025 results, something happened that a lot of people had speculated about, but there was no guarantee of, which is that they said they're going to take over like one of their few competitors, which is called a company called Indue. And so that initially, in first glance, seemed to put the company in a position to just grow profits as it removed for like ages, as it removed duplicated expenses. So suddenly you have this kind of like low growth kind of business, as I said, kind of clip the tickets as financial institutions that are not the big banks grow, it sort of should naturally grow. But on top of that, now it has this big acquisition where it reckons it's going to take out heaps of costs. To wit, it said in the announcement, the acquisition price of Indue represents 25 0.3 times earnings, a PE ratio of 25.3 based on the current run rate earnings of Cuscal. Okay, that's a bit high, but here, wait for the kicker, a price to earnings ratio of 3.7 on a post-run rate synergy basis. Now, to get an idea of what they mean by that, we have to like go to the footnotes. But basically, they say based on transaction value divided by the FY 2025 Indue NPAT, and then the FY 2029 run rate post-tax synergies. It excludes integration costs and interest income foregone from cash deployed, as these are borne by Cuscal. So essentially, this is what they're saying is that we're going to gradually be able to make more and more profits out of this over the next like 4 or 5 years, or 4 years, whilst we gradually, get synergies and cut costs and stuff like that. So what it's saying is that, growth, according to this, should be a little bit higher. Now, that is the story, and that is interesting. But what happened was when I read this, I actually bought shares, a few more shares. I already owned shares after I think when I wrote that potential hidden gem radar stock, I did not own shares then, but after I wrote it about it being a potential hidden gem flying under the radar, then I bought my first parcel of shares. That was before any of this Indue stuff. Now, with his FY 2025 results, which were otherwise I guess good, just good enough, unremarkable, that has basically been a bit of a bonus to the thesis, because I never even considered that. There was always this possibility when I was doing my research. I talked to other people saying, "Hey, this is a possibility," but I never I wasn't counting on that, and I had estimated a profit of 25 million. And if you look at the actual results, what was it now?
28.7. I've got them up in front of me.
Thank you, sir. So it came in above my estimates are often, especially it's a stock I don't know very well, I tend to try and make more conservative estimates because I just prefer not be over optimistic. And so when I see results like this, okay, it's come in above what I was expecting for as at least my minimum. And also on top of that, it's got this bonus thing that should definitely make it get more attention. And this is where it gets interesting, right? The share price after this shot up immediately on results, right? And then it has dumped down a little bit since then. And I would speculate that, and I have no idea if this is correct or not, by the way, but I speculate that yes, the share price went up after these ostensibly good results. And then potentially some of those people who've now got their shares out of escrow are taking profits. So that's pushed the share price back down. So on the one hand, you have this possibility where maybe all these people that have been waiting to sell are just slightly depressing the share price. And then when that stops, the share price will go back up. Or it could be this whole conspiracy to make the share price go up right now when they can finally sell. And actually this Indue, I'm not saying it's a conspiracy really, but I'm saying, maybe the Indue acquisition that the market's so excited about actually won't perform anywhere near as well as it is hoped, and it's going to go down from here and have disappointment. So it could go either way. I'm not making any prediction. my initial thought was, though, I did actually, when these results came out, which was just on Friday last week, I did buy a few more shares because I thought, look, to me, this looks like if it does deliver what they say it's going to deliver, then this company's got a few years, 3 or 4 years of like just solid growth. And if it can just grow profit for a few years in a row like that, then I definitely think that it will get a lot more attention in the market. And it's kind of just like that new listing, like a lot of people, myself included, tend to avoid new IPOs. Like that's why I wouldn't, I haven't recommended other people buy this stock or anything. It's not a recommendation because I just need longer to like judge the company and observe it in the public market. But for myself, just as more of a bit of a speculation, it's interesting because it's also $693 million market cap. So with a bit more growth, with a bit more liquidity that comes, if these escrow people are selling, that should increase the liquidity. It's $700 million market cap company. Like there's a certain point where like this is starting to become a candidate for inclusion in like ASX 300 or what have you. So if it can keep growing, for sure, like I think that kind of thing could be on the agenda for it. It was only in, let's see, that was in March that it got added to the All Ordinaries. So yeah, if it can string together some good, like decent profit growth for a couple of years, get a bit more attention, share price goes up a bit more, suddenly then it might be on the cusp of the ASX 300. I have no idea, but this is just the kind of imagining that I have, which is why I bought shares. And then it can just, it's like a sociological thing. Do you know what I mean? So I don't really have the confidence in the Cuscal business. I haven't followed the management long enough. I haven't followed the business long enough. It's just generally, I'm just not quite there, but I'm on the path to get there. Like this could be a great performer. It has some stuff I like. If they tick every boxes, I could see this more and more people, myself included, gaining conviction. And then that's what makes the share price go up. So that's why I bought some shares in Cuscal. But again, like that doesn't mean you should do it. I know what I'm doing, and I also might change my mind at any time. And I position size correctly, and essentially, yeah, definitely, basically, don't do what I do. I'm just sharing what I do. So you can be like later on, oh, he was right, or oh, he was wrong. And I guess that's like part of what I've been doing for 10 years is investing in public, really. And there's a lot of things I don't like about investing in public, but what I do like about it is it makes you accountable for, I guess, okay, this is what I did say. This is what I bought. This is why I bought. Like, I think I've observed in people, they might buy shares and then 2 years later it's up or down, blah, blah, blah. They have a bunch of thoughts about. They definitely start rewriting history about why they bought shares or what they thought that, like when that happened. So the good thing about me telling this kind of story, I think of it as gonzo investing, like doing it in front of people. It's pretty embarrassing sometimes when you get it wrong. It's pretty fun when you get it right. But I'm not saying this is a buy. Like what I'm saying is I don't know enough about this company to have like strong conviction either way. I'm just responding to certain heuristics with like a small amount of my money because after more than a decade doing this, like I've seen sort of similar stories play out over and over again.
How did you feel about the decline in net profit after tax versus the previous financial year? I was looking at their accounts and it showed 30.1 million in FY24 compared to 28.7 in FY25. Their operating income was up, so it looks like it's kind of an expense thing that has driven the lower profit there. What was your take on that?
Oh gosh, you're testing me now. Let me just look at the accounts. So like the big increase came in other expenses. So there'll be some reconciliation somewhere, but this is a fun way to do it. Here we go. This is what I thought it was, but I just wanted to check it in the notes of the annual report before I said it on the podcast. It's the IPO offer costs, mate. And that's a typical thing you do see in a recent listing is often that first sort of set of results, the statutory profit will be lower because they've borne a lot of the costs of the IPO. In this case, last year, there were IPO offer costs. So in the comparable period, it was 3.6 million that they spent in FY 2024. And then in this year, it was 13.4 million. So it's like roughly a 10 million difference just on IPO costs. So if you then sort of just imagined a situation where they didn't have that difference, I think, I'm not sure exactly what numbers you'd get with tax and all that sort of stuff. I'm scrolling up now to try and tell you off the top of my head. I can't. But the point is like that it wouldn't be shrinking if it didn't have that IPO offer cost. It would be growing. And also it's not going to have that IPO offer cost again anyway.
Yeah. It's one of those genuine one-off costs.
Yeah. So this is the difficulty. Like I totally applaud your question because I think that as investors, especially small cap investors, your first instinct when you see pro forma, normalized, adjusted, whatever it may be, your first instinct should be like, yeah, nah, like I'll decide the adjustments, what I want to make. And there's definitely different companies. I give different levels of credence to the adjustments they make. All in all, I think that giving these pro forma numbers in Cuscal's case is definitely helpful, right? Because the pro forma results that they put are adjusted for the non-recurring offer costs and costs incurred as a direct result of activities associated with the listing of Cusco. So that is just totally useful to me. And if you look at and also earnings per share, but if you look at the pro forma earnings per share, then what you have is FY 2024, 17.2 cents, FY 2025, 20 cents. If you look at statutory, you have it going in the wrong direction, like what you called out on the statutory profit. So just for the sake of this year with the IPO costs, I'm more or less happy to accept that 20 cents per share in earnings as a bit of an earnings run rate. So we have a share price of $3.58 right now. And so that's a P ratio of like 18. Yeah. Okay. So we need some growth from that. Well, that's supposedly what we're going to get from this Inju acquisition. That's the story. That's why it's potentially good. So we'll see what happens. Could be more selling pressure with the shares out of escrow. Who knows? I have no idea. If this particular stock will go up or down, I'm just telling you the heuristics I look for, like the pattern that I sometimes think is good. But like, this could play out. It could get in, it could grow, it could do 2 or 3 years of modest growth. Its P rate, its earnings get a bit higher. Its P ratio probably stays the same or maybe even gets a bit higher. Because if it does 2 good years of growth of say, 5 to 10% growth, then yeah, it could 10% growth. It could definitely get a PE multiple of 20 for like a stock that's a bit of a tech stock. It's the right kind of size to start catching attention of funds and potentially then you have people speculating it'll get in the index. Oftentimes, once you see a lot of people speculating that it's going to get into the ASX 300 or it is looking like it did get into the ASX 300 and now people are speculating about the ASX 200, oftentimes that can be a reasonable place. Like this is a sociological thesis. Like, is it all over the place in Livewire? We have at least one person, fund manager, writing about it in Livewire, that's for sure. And and I think, did we do a bit of a survey? There's a few people talking about Cusco, but it's definitely not it. Like, I'm not seeing a lot of it. Cuscal, most people haven't even heard of it, doesn't know what it's done, what it even does. So, I think there's definitely upside sociologically there. So that's kind of what got me interested.
Yeah, we were actually discussing this issue around adjusted earnings this week. And my view is, as long as it's clearly presented and it's well justified, I'm fine with adjusting out expenses that are genuinely one-off. But if you've kind of got to go to the appendices of your presentation,
well, you often do though. That's the reality. Is you often do have to go, and even what I had to with Cuscal, go and see, and it was fine. And well, the pro forma number adjustment's fine. I'm not talking about any other number they put out, but like, you have to always read those footnotes and have a look about it. So that's part of what I want to do on this podcast is basically, share a little bit of the process of ASX small cap investing. I've done it a long time now, such that like with more than 10 years, like I've finally convinced myself that like I'm definitely sure that I like know, or at least what I've been doing for the last 10 years has definitely worked. Like my returns are too much bigger from, the market for it just to be pure coincidence. And what's more, that holds true for my personal portfolio. It holds true for like the recommendations I made at Motley Fool Hidden Gems years ago. And it holds true, albeit on a much smaller time frame, on the recommendations I've done at A Rich Life as well. So that's the process, is definitely always check out what the adjusted numbers is. I'll tell you, you'll be better than, because as an investor, you want to be in the top 25% of being able to understand correctly, what matters to where a company goes. Well, at a glance, the adjusted numbers being up could make a difference, but ultimately and for some stocks, they can just continue to like make the share price rise for ages based on hopes and dreams. That famous thing is like, it's easier to like ramp a no revenue stock at all. Like that's the easiest one. It's like no revenue at all. Just like imagine how much it's going to be. They're the ones that can go the most insane prices. But then they, often go back down. Not always, but usually go back down. Anyway, that's a bit of a side note there. Okay.
Shall we discuss PWH?
Absolutely. I'm very excited that we look like we're going to finish this podcast in good time. So let's do the last one.
I'll try and get straight to the point then. Look, so PW...
I'll join in on this one as well.
Yeah.
Because, like, I have my own gonzo investing experience with this, which is very different from yours. But tell us your experience. Like, where did it start for you? When did you buy shares?
So I'm only relatively recently into this company. So PWR Holdings, or PWH, do advanced cooling solutions for racing cars, for aerospace and defense, and for really high-end supercars and hypercars like the Aston Martin Valkyrie. So I'm an unashamed diehard for F1, and so PWR Holdings actually supply 100% of the F1 teams with their cooling solutions, which, it's the premier motorsport category in the world. I think if your cooling solutions are good enough for them, they're probably pretty good. They have had a pretty rough run the last couple of years, or really the last year or so. It's not really a couple of years yet, but they have just moved into, or in the process of moving into, a new factory. There are significant expenses associated with that, and that also coincided with two of their divisions kind of having a fairly significant fall off. I'll put the segment by segment earnings up on the screen just so you can see how significant it was. But so that is their aftermarket parts and their OEM. So basically, when they sell a cooling solution, say to Aston Martin, for them to put in their Valkyrie. So those two segments had a really poor performance this year, and there's a lot of operating leverage in this business, which means that when revenue declines a little bit, earnings can decline a lot, which is exactly what's happened here. My view on this is that the two segments, even though they, at least going back as a year ago, they were very significant parts of the overall earnings, I don't really see them as being key to the long-term future of the company. They're not completely insignificant, not suggesting that at all. But to me, the two key segments are the motorsport segment, and they absolutely dominate motorsport to the point where it's not.
So part of the reason you like this stock is because it lets you use your pictures of F1.
Yes, and make motorsport related puns.
Which I then have to edit out. No, I'm glad you enjoy writing about it, and those pictures are fantastic. I can't believe how good your photos of cars are.
I appreciate that.
But so I'm going to jump in to just summarize some key points here for people. So it got its start in motorsports. Like, people want to pay top dollar for the best equipment for their engine. Okay, great. So it's a premium product. And then it has like OEM stuff where it's like making for other like what just normal cars that like they're supercars or really great cars, but they're just the OEM stuff, which Patrick doesn't think is that important. I agree. And then the exciting part is like the aerospace and defense part, which is also more US focused, obviously. And that's where they've been trying to grow, but it's like not come as easily as they might have hoped, I guess.
Yeah, it has been a little bit lumpy, but I guess the nature of government contracts or defence contracts is that they're slow to move. And so that affected their revenue in the second half because they have a major contract with the US government, which ended up getting pushed out to FY26 in terms of when it'll be booked as revenue. Look, the overall trajectory of that division is good. I do think that is really where the growth is coming from in the years ahead.
The second biggest division now as well. So that's
it is.
Yeah. So
yeah, but the motorsport is still the biggest and will be, I would expect, for some time yet. It's around 50% off the top of my head of gross profits and revenue. So if things aren't going well there, then it's really going to have a big effect.
You bought it though after its recent fall, when like this sort of bad news started getting already priced in, right?
Yeah, that's right. So I bought it when it was kind of just before the end of financial year this year.
Yeah. So you even might be like, the current price is $7 something. You might be like mildly up on it, $7.63 or something.
Yeah, not much, but I'm definitely not holding a massive bag on it at the moment. But
cool. So now I get to share a story of one of my failures, which is that I guess I can tell this now, is that previously PWR Holdings was no longer is a recommendation of A Rich Life. And I lost money for myself and subscribers on that one. I hasten to add that the overall performance of the recommendations are extremely good. We've had more than one that's more than doubled, put it that way. So your wins make up for your mistakes. But this one was one of my mistakes. I basically recommended it right before it became apparent that they were going to do this big expenditure on moving factories, essentially. And then once I realized that this was going to obliterate profit for the medium term, I sold. And it wasn't so much that I object to them investing in the factory. It was more that I didn't feel comfortable with the timing of director share sales being not that far before they announced this big expenditure, which is like a legitimate thing that they might do. But it definitely had a impact on profit, at least in the short term, that the market was not expecting, as demonstrated by the fact that, prior to the company announcing these plans, the share price had gotten to almost $13 and it was trading above $12 for quite some time. And then, ultimately, so far, it's gotten as low as sort of $6.30 as it has become apparent that, FY 2024 profit was going to be the highest profit the company was going to be putting in the near term, put it that way, by a country mile. So, I don't like it just makes me feel uncomfortable. I don't like to see that kind of stuff. Like, I like to see if there's a big management sell down, a big founder sell down. I like to see, for example, the way Pro Medicus has done it, which I also own shares in, still own shares in, and have been talking about since it was $1.50. But and it's very expensive now, and I don't blame the insiders for selling some of their shares in Pro Medicus, but what I like to see is that they sell shares and then the company continues to perform well. Like, the profit goes up, they sell shares, next year profit goes up. They sell a few more shares, next year profit still goes up. I don't like to see they sell shares, profit falls off a cliff. For me, yeah, maybe just coincidence. Not saying, I'm not alleging anything, but I'm just saying I invest based on many years of experience of seeing the same patterns over and over and over again. And I'm telling you, like, the reason, for example, I once recommended way years ago Monash IVF, right? Back in Hidden Gems days, I recommended that as a buy. Look, I don't want to quote myself because like my memory fades. It's 10 years, but literally what happened with Monash IVF is the CEO 10 years ago. The share price was like $2.40 or whatever. The CFO sold shares and then not long after quit the company, and then not that much longer after that. I can't remember exactly when in this process I issued a sell recommendation. By the way, I think it was after the CEO quit. Don't quote me on that. But then at some point after that, like one of their star doctors left the company and set up a like competitor, and then they're like suing that doctor to say you have to go away, further away or whatever. And it's like, I'm telling you, like by the time the market knows the bad thing fully, it's often too late. So the way I try and do it is like when I get those like weird bad signs, I will get jumpy and I'll sell. And sometimes that sell is the wrong decision, and that may well be the case in PWH, but that's what I did. So like I just took the loss and moved on because like I don't feel, like it's just not where I want to play. Like maybe it could be a opportunity for somebody else, but my particular style, especially with the recommendations, so I buy shares in each recommendation after I've made it. So by far, the stocks that I've recommended to subscribers are the stocks that are in my portfolio, right? And for my own like mental health and strategy, like I need to have only companies recommended if I like really do have full confidence in the board and management, and just know I really do think in my heart that long term they're doing the right thing for us and for the people that have trusted me. And so that's why I will. Sometimes the best opportunity is an opportunity where, you've recommended the company or you've bought the company and it's all good, and then something unlucky and bad happens, but it doesn't impinge. It doesn't say, "Oh, management is bad and they've tricked you" or anything. I think we've talked about Energy One on this podcast before, haven't we?
I'm pretty sure we have. It'd be surprising if we hadn't.
Well, anyway, like I own shares in that disclosure, but I don't want to talk about them right now. But I just wanted to say, like, imagine if you'd bought shares in that after all like the cyber hack stuff was happening. You'd be paying like $5 or $4 or something like that because they got cyber hacked by people, and that was a tough time. And then and that in fact impacted their profit. And if you bought shares in there, you're like paying $5 something or less, and then just a couple of years later, that kind of recedes into the background, and the profit goes back up, and then the share price is $10 or doubled. And so if something bad happens, but it doesn't impinge on the quality, like the long-term quality of the business, or suggest that the people might not be that bullish or whatever, it's just like a bad luck thing, that can be a good time to buy and to actually buy more. But if it's like a whole sort of stinky situation, I prefer just get out and then look for the like the stuff that I feel more comfortable with. But that's just my style. I know other people have a whole different style from me that may work perfectly for them. Like there are small cap funds that make great money by just shorter term trading. I took this money in this placement, there's a great story, and then they go out and tell the story, and they try and make a 30-40%. They're actively like telling people about this stock, and then it goes up 50%, and then they'll sell it. I rarely am selling a stock when it goes up 50% from when I first recommended it. I would have to check. Like that could definitely happen if it went up a bit and then something bad happened. But if things are going well, like I'm looking to hold for a really long time, which means I'm also willing to ride ups and downs because that's inevitable. So I want to have management that I really trust. So when the things are going down, I can be like, no, this guy's really smart, he's working really hard, he's a good guy, and he's going to try and sort me out. I need to feel that, or otherwise I know myself psychologically, I will capitulate at the worst moment. And for all I know, that's what happened, that I've done that before. So that's my weakness with the strategy I use. The weakness of it is sometimes you are actually making the decision, nah, this is a problem, I'm going to sell. But it was one of those times where it wasn't actually that big a deal and you should have just had more faith in them. And that could be the case with PWH. I'm not sure. It's always just a probability judgment, I guess.
Yeah, no, I'd agree with that. I think with the benefit of hindsight, well, maybe not hindsight, but we've got some more information now, right? And it seems my assessment of the situation, based on the publicly available information, is that the sells that were being made by PWH last year, I don't think had anything to do with the factory or anything like that.
It wasn't last year. It was before that.
Sorry. Yeah. But, I think with the recent situation with Keys is the founder and currently CEO, I think it probably had more to do with his health and family situation. So I'm happy to, I guess, give them the benefit of the doubt there. But I understand,
like I say, I'm systemic about it. Like I'll even if I see a CEO leave, a CEO, like I've done this recently, a CEO announced they're going to go and it's the most harmless thing ever. Like he's like giving 18 months notice. He's like personally telling me like, dude, I just want to retire and like enjoy my life. Like, I'm like, yes, that totally makes sense. I would do that too. Like, I'm not going to, like, you have a lot of money as well. Like, you should definitely go and do that. But it seems as clean and green, like absolutely no issue, like the absolutely smoothest, no trouble whatsoever. Like this is 99% fine. I'm like so systematic about how I invest is I'm like, I still have to just sell at least some shares, like, because, and that's probably wrong. And I hope I'm wrong because anytime I'm selling like 5% of my holding or some tiny profit take like that, I hope I'm wrong about that. But it's just, the way I've ended up training myself is to overreact to the stuff you can't quantify and underreact to the stuff you can quantify, unless you actually think people are not quantifying it properly, which often happens. Like, so for a small cap company, like if you figured out the real, free cash flow and earnings power is up, but like, people are unimpressed because the adjusted EBITDA or whatever is flat, that could be the kind of insight that you will make money on. But generally speaking, once a company gets to a certain size, it's very hard to get an edge based on like some sort of quantitative insight. It's very hard to like be like, I'm going to estimate the profit next year exactly better than all the analysts and the fundies and everyone has this 2 or 3 year, because their whole thing is like, I'm going to try and get as close to possible as what the profit that guy's going to make in 1 year or 2 years. And that's how I'll get marked. And the fund managers, the good ones, aren't worried about 1 or 2 years. But, there wouldn't be many fund managers that aren't at least a bit worried about 3 years. And by 5 years, they got to be worried for sure. And I think it's reasonable for anyone to be looking, what's going to happen in 5 years. Like I'm also thinking about what things looks like in 5 years. I think 5 to 10 years is kind of a sweet spot for an ordinary, somebody who's, passionate, intelligent, and dedicated to trying to predict what's going to happen to certain companies in the future. I reckon the sweet spot to actually get an edge is 5 to 10 years out, and also to use qualitative factors to guide that more than where the numbers are today. But like, even having said that, I think PWH is a great one to discuss because even though I've previously taken, and it was some time ago that I sold now, like since then, I don't know, actually it has had a bit of a rocky road since then, to be honest. So there may still be other opportunities. And yeah, it's one I'm watching. It's a great one to discuss. I'm totally open to that. I was just too impatient and be wrong. And I find like most of all, I did this whole analysis on all the sell recommendations that I ever done, right? And on average, the stuff I sell goes up and beats the market. And the only reason it makes sense to do the sell recommendations is because if you assume that I've sold something and then redeployed that capital into the new thing that I wanted to buy. And then on average, the stuff that I'm like redeploying into, like the average of my overall recommendations, that return, which I haven't updated, it was like 20 something percent. Do you remember at June per year? I can't remember now. It's been up since then, but it goes up and down. I'll check what it was at June because I've got that written down. But so like as of, where was that? As of 30th of June, we were going at 28. The Rich Life recommendations were going at 28.17% per annum if you assume that you just like followed it after every recommendation I made according to that at the closing price afterwards, and also assuming no brokerage, by the way. So I guess once you include brokerage, it'll be a bit lower. And it's gone up since then. I don't know the exact number, but it's even higher since then. The reporting season's been largely good for us. Look, the point I wanted to make is on average, my sell recommendations, like that stock still goes up and better than the market. And the only reason it makes sense for me to do it is because the other ideas I have that are my best ideas tend to do a bit better. So really, at a certain point, any stock that's not in your best certain number of ideas, well, you're better off in the best ones, right? So that's kind of where I landed with this. But I could definitely be tempted back in with. I could imagine myself being tempted back into PWH one day, but today is not that day.
Fair enough. Well, I think we've covered all the stocks that we wanted to cover. If anybody's interested in joining the waitlist to become a supporter of A Rich Life, which is how you can get access to Claude's official recommendations, I'll leave a link in the description to this video, or if you're listening to the audio version, I'll leave a link in the show notes there.
Cool. And please, if you're listening to this, whether it be on the podcast or YouTube, even Vestival, could you please subscribe or leave a comment? That means the world to us. And also lets us know we should keep doing this because, that's the whole point really, is to get it to reach a bigger audience. So if you can help us with that, we really appreciate it.
All right. Well, thanks everybody for listening and tuning in. We appreciate the support. And unless you've got anything to add, Claude, I think we can probably...
I hope everyone's had a good earnings season. Like, how's your earnings season been overall, I guess, is how we can end it. Like, we're in the second last day, so it's probably going to get a bit worse. Tend to get the worst reports at the end. But how's it been so far for you? Like, good, bad?
Actually, pretty good. I've had a couple of companies that have just done really, really well, which has definitely brought my overall average up quite a lot. As you said, the Friday afternoon ones on the last day of reporting seasons is the ones that you worry about. But I'd say this week in particular, it's been very positive. So I'm feeling pretty good after this reporting season, though definitely looking forward to it being over.
Yeah, tiring times, and plenty to catch up on as well. Yeah, for me, today's been the roughest day for sure. So I'm bracing for tomorrow, but so far so good in the overall earnings season. All right, thanks a lot for listening to everyone, and definitely send us your suggestions or any other ideas for topics as well of what we should cover on the ASX Small Cap Wrap. All right, thanks all.
That's a wrap. Guests or hosts may have positions in the companies mentioned in this recording. The information contained in this episode is not intended as financial advice and is not a recommendation to buy or sell any financial products. We do not warrant or represent that the information, opinions or conclusions contained in this episode are accurate, reliable, complete or current. You should be aware that any references to past performance are not an indication of future performance.